What do you do as a business person when your core business has indeed gone into secular decline? That's a question many companies have been forced to address. Companies like Pitney Bowes, PBI for you home gamers. In the old days, Pitney Bowes was a major player in the snail mail business. They sold mail meters and equipment that helped offices send postage. But with the rise of the web, the company's had to transform itself, becoming a global logistics and technology company with some fast-growing e-commerce software. Of course, these transformations don't always go smoothly. By their own admission, they'll tell you that. And the mail business is still in decline, which is why Pitney Bowes' stock has seen it's been tumbling. It's down 15% year to date, down 25% last year. Now, we know that turnarounds take time. Still, if you can stomach the risk, this company's paying you to wait with a bountiful 5.8% dividend yield. So let's dig deep with Mark Lautenbach. He is the president and CEO of Pitney Bowes. Find out more about how his company's doing, where it's headed. Mr. Lautenbach, welcome back to Mad Money. Good to see you, sir.
Sure, it's good to be with you.
Thank you, Mark. Now, because I did mention the dividend, first of all, you have free cash flow of more than $400 million.
Yes.
So to me, that says, do not panic when you see a 5.8%.
We have the proverbial moat around our core business. We've got strong market share. We've got good market position. There's regulatory barriers to entry. And that sustains the cash flow. And that gives us a degree of flexibility as we run our business.
Okay, you unveiled a commerce cloud, Send Pro. We're big cloud believers. Tell us how that's going to work.
So if you think about what Pitney Bowes has meant to mailing over the last 100 years, literally. We haven't originated the mail. We don't own the mail. That's what our customers did. We didn't move the mail. That's what the USPS did. What we're positioning the company to do going forward is to do that same work around shipping. Take the complexity out of shipping. So we're not going to own the packages. That's what our customers do. We're not going to move the packages. That's what FedEx and UPS and USPS do. But we're going to take the complexity out of shipping. And the way we're going to do that is a series of applications delivered on an Android device offered as a software as a service. So you think about the company had been a monolithic, analog, single application, and what we're moving to is a digitally connected software as a service applications, certainly around mail, also around shipping, but also around a series of other applications as well.
Okay, now there's three things I want to try to figure out. One is, in your own conference call, you said, look, we're not doing as well as we should. Okay, so maybe that's why the stock's down. The second is there's an outfit called Stamps.com that takes you on. When you go to their site, they just say, listen, we're much better than Pitney Bowes. And then finally, there's the perception of the metering. My father always had the metering, and I saw, oh, geez, he doesn't have to go to the post office. He just meters it.
Right.
Perception, the worries about the dividend. I mean, give me what you think is causing the twin declines last year and this year.
Yeah, I think there's a couple of things. So if you look at the stock since I began, we had a quick run up. There were a lot of quick wins.
Right.
We cut the inventory in half. We had DSO. We cut expense. So the stock ran, and it ran pretty hard. Right. The investors believed in what we were trying to do. They saw the quick wins. Then we entered into the hard stuff. All the changes in the business processes, all the new technology, investing in the brand, investing in the products, investing in channels. And while those things were necessary to create long-term value, they were disruptive. And we've had some adjustments to go through as we went through that. That said, those are the necessary things you need to do to create long-term value.
Okay, so in the last quarter, you finished by saying second quarter was a complicated quarter. There were a lot of moving pieces. Going forward, will there still be a lot of moving pieces, or will it start to come clear to people?
I think yes and no. We're not done. So we've done a lot of the heavy lifting. The way I liken it with our team is, we've been in the preseason. We've trained. We're starting to get execution. You can start to see some growth. I mean, we created this e-commerce business that's now growing 15 to 20%. The software business has begun to stabilize. We had an exciting new product and an exciting new acquisition that we announced a couple weeks ago. So those begin to be the pieces of how we go forward.
Talk to us about that acquisition, because it did seem very important.
So Nugistics is a company that really cut its teeth on returns. So they do 50% of the returns for USPS. So as you think about e-commerce, one of the big inhibitors is, if I don't like it, can I get it back?
Right.
Nugistics solves that problem for customers. Inside of our portfolio, it was really an inside straight. We had e-commerce, which was a business was all around cross-border trade, but no real domestic capabilities.
Right.
And then we had this business around pre-sort of mail, which was domestic logistics of kind of infusion of mail into the mail system. They were both coveting an asset that had domestic parcel capabilities. So usually you get one business that wants to buy something. We had two. So you think about it from a customer perspective, which is the way I tend to think about it. We had our global e-commerce customers that wanted help domestically. We had our pre-sort mail customers that wanted to move in parcels, and logistics customers wanted help with cross-border. So it was a perfect fit.
Well, how quickly will the customers know that you filled in the hole?
So they know it already.
They do.
So we haven't closed yet. We're still working, but the customer, the reaction from the debt agencies, the investors, but most importantly, the customers has been instantaneous and it's been positive.
Okay, so let's say maybe not this quarter, maybe not, but a year from now, will we understand all these different parts and say that this isn't a secular decline story? This is an e-commerce story that really gets how to move something from A to B?
Yeah, I think you will. And you'll start to see signs of that earlier. I mean, so as you probably noticed, we upped our revenue guidance for the second half of the year.
Yeah, I thought that was great.
So,
I was surprised the stock cut, isn't going higher. But you're right, it ramped because the cost savings were so great. You took out so much cost.
So, I mean, we were the proverbial melted iceberg.
Right.
We've moved the weighted average growth of the portfolio to -2 or 3 to +2 or 3.
Right.
And to do that, we've done a lot of work. We fixed the balance sheet, we fixed our systems, we invested in brands, things that we needed to do.
Well, look, I think it's going to come clear, but you're very frank. I mean, people should read through all the documents because this is a company that just tells you exactly how it's doing, warts and all. That's Mark Laudenbach. He's the president and CEO of Pitney Bowes. Mad Money will be back after the break. Thank you, Mark.
Thank you.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.